Hi, I'm Cleon from ClearTax. In this video, I will tell you about the difference between ETFs and mutual funds. A mutual fund is a professionally managed investment fund that pools money from several investors to purchase securities such as stocks, bonds, and short-term debt. A fund manager manages your money according to the investment objectives of the fund. ETFs or exchange traded funds are basically index funds that are listed on the stock exchange and track a market index. Let's understand the difference between mutual funds and ETFs. What is the difference between mutual funds and ETFs? You may consider ETFs as a type of mutual fund which trades just like stocks. It is essentially an index fund that tracks a market index such as Sensex or Nifty. It is a form of passive investment that is popular across the world. You also have ETFs that track sectors and commodities. A mutual fund is an investment fund that pools money from many investors and invests in equity, debt, or a mix of both, depending on the investment objectives of the fund. You have actively managed mutual funds where a fund manager manages your investment. ETFs are traded throughout the day, whereas mutual funds are priced at the closing net asset value of the day. Mutual funds or ETFs, which is better? You may consider picking mutual funds based on investment objectives and risk tolerance. You have to decide if you want to invest in actively managed mutual funds or a passive investment such as ETFs. You may find an actively managed equity fund beating the benchmark index such as Sensex or Nifty over some time. ETFs give returns in line with the index it tracks. However, they have a lower expense ratio as compared to the actively managed mutual fund. Invest in actively managed equity mutual funds if you are an aggressive investor. You could consider ETFs as part of your core portfolio if you are not comfortable with too much risk in your portfolio. You may find many fund managers of actively managed equity funds struggling to beat the market index in recent times. You could invest in ETFs that offer returns in line with the index and have a lower expense ratio. However, you can consider actively managed equity funds if you are an aggressive investor. Thanks for watching.